Investing in real estate usually takes capital, and typically first-time investors use their own money to invest. This usually works to buy a couple properties that are free and clear, but soon most people typically run out of their own capital, which means that they either have to stop buying real estate or they have to figure out a way to buy more real estate without using their own money. And in this video, I'm gonna show you a number of ways that you can actually finance your next investment property. But first, if you're new to my channel, welcome. My name is Lillian Chukwueze. On this channel, I talk all about real estate, entrepreneurship, and investing. So if any of those topics interest you, go ahead and subscribe to my channel. Hit the like button and the notification bell so you don't miss when I drop the next video. And also follow me on Instagram and TikTok. So the first way that you can actually buy an investment property is the typical way that most people do so, which is by using traditional banks and lending institutions. And if you have good credit and enough money for a down payment, this can actually be an effective way to acquire more properties and potentially several more properties. But you'll definitely need to make sure that your credit score is in good shape, so be sure to pay all of your debts on time, pay them off in full regularly to demonstrate a history of good credit management. And once you build up good credit, financial institutions will be more willing to lend to you so you can actually go out and acquire some properties. At some point, however, your debt to income ratio might exceed a bank's desire to lend to you once you have a certain number of properties under your ownership. So when this happens, that means it's time to actually turn to other sources to finance your real estate investment properties. And if you need to figure out what your debt to income ratio is, you definitely want to use the DTI calculator, and I'll post it somewhere down below. Now, the next option to fund your investment properties is by self-financing. And what I mean by this is to actually use your real estate investment properties to borrow against existing investments and use that money to buy new investments. For example, if you already own a couple properties and they have some equity in them, why not borrow against them by refinancing or taking out a home equity line of credit and using that money to acquire more properties. Now, this is the true power of leverage at work in your investments. If you've ever heard of the BRRRR strategy, BRRRR method, then this is the time to use it. People talk about it all the time. BRRRR is basically short for buy, rehab, rent, refinance, and repeat. Now, this method allows you to recover most, if not all, of the money you initially invested into the property. Always make sure that you're actually buying correctly, typically at a 20 to 30% discount or whatever number that makes sense for your exit strategy. Then you'll have to obviously rehab the property to make it livable and functional and make the proper enhancements that'll directly increase the value of the property. Then you'll have to rent the property out to a qualified tenant before you get an appraisal, because banks do not want to refinance vacant properties at all. They look at it as a higher risk. So you gotta refinance with a bank that'll actually offer you a cash out refi and will also lend on the appraised value, preferably as soon as you've rehabbed it and rented it, so you can get things moving right away. And then at that point, you just repeat the process. And of course, you'll want to be careful that your debt servicing payments are not more than the income that you earn from your new acquisitions. And of course, you'll want to be careful that your debt servicing payments are not more than the income that you'll earn from your new acquisitions. But there are some investors who build up a large portfolio just with their own credit and own self-financing. So another way to finance your investment properties is by private lending. Now, private lending is simply when another investor lends you their money and you pay them back like you would pay a bank back. The only difference is private lenders don't always look at your credit score. They're often more interested in the investment itself, and they'll decide how much to lend on you and what interest rate to charge you based on the assessment of the property. Now, this is a very powerful kind of financing because it's basically a win-win for both parties. You win by getting the money that you need to do the deal, and the private lender wins because they want to invest in real estate and they have the money to do so, but they may not have the time or desire to go out and find the properties themselves and work the deals. More and more people are starting to understand that leaving their hard-earned money in a savings account is no way to grow their assets. Private lending is usually the most convenient form of financing because typically your lender is somebody that you know, like, and trust. Could be a family member or friend or even an associate, but since the lending is not coming from a traditional institution, it gives you more flexibility to negotiate the terms of exactly how and when your lender will be paid back. Now, you'll see a typical private loan example down below just so you get an idea of how a typical deal works and how a lender will be paid out. There's a bunch of different ways to structure how a lender will be paid out. It can be just through interest-only payments. It could be through some money up front, money on the back end, equity. There's a bunch of different ways to do it, but the great thing is, again, it comes down to the flexibility of you and the investor. Now, if you are a private lender who wants to invest in real estate without the effort of doing the work yourself, be sure to connect with us. I'll leave our phone number down below. We can hook you up with some investors who are actually looking for money for their deals, and they have some really, really great terms. Now, the fifth way to fund your investment properties is by using hard money, which is another common form of lending that many investors utilize. Now, hard money is a type of financing provided typically by a group of investors or small lending companies. So in many cases, if the deal is good enough, the hard money loan will be provided to the borrower. Now, this type of loan is a short-term financing solution, typically for investors who are doing flips, because hard money is really expensive. The interest rates can range from 9 to 15%, even more. They also may charge 1 to 5 points of the loan for financing fees. And the repayment period is relatively shorter. It can range anywhere from 3 months to 3 years, because again, these loans are mainly for flippers. But the speed and convenience of being able to obtain a hard money loan when a good investment opportunity is in front of you pretty much trumps the cost. And after you've properly analyzed the deal and determined that it will yield good profits, at that point you can then search for hard money lenders. Now, another great way to finance your real estate investments is to use seller financing. So seller financing is pretty much where you work with the sellers themselves who will sell you the property. Instead of getting a lump sum for the property, they simply take ongoing payments until it's all paid off. So in other words, when you're buying the property, the seller becomes the bank instead of you having to go to an actual bank and get financing that way. This is also sometimes called creative finance, which is basically the umbrella term for different strategies within seller financing. And newbie investors are sometimes surprised that this method actually exists, but sellers actually like it because they get cash flow without the headache of the property ownership, plus their risk is minimized because if you fail to pay, the title of the property simply reverts back to them. So it's another win-win for you and the seller. And I actually made a video about this called Creative Financing Explained. If you don't understand how it works, you can go check it out. I'll link to it above and below. And hopefully that video will help you get a more solid understanding of what creative financing is and the different options within creative financing that you can offer to sellers. Now, this strategy is really great because it also gives you more flexibility depending on the situation of the homeowner to create favorable terms for yourself as well as the seller. You can negotiate the down payment, if any, the interest payment, and the monthly payments, and the time you'll need in order to complete your exit strategy. We all know a good real estate deal, or anything for that matter, is made on the buy. So make sure you do your due diligence in order to determine your all-in costs and your exit strategy before purchasing anything. So how will you finance your next real estate investment? You might want to dive into these powerful financing strategies that I previously mentioned, mix and match them for the best result for you. And if you're eager to invest and you just need deals or money to help you get going, definitely click the link below and fill out the short form to get started. We love to help you build your investment portfolio. And with that being said, I hope this video was very helpful for you guys. If it was, go ahead and hit the like button, subscribe to the channel, and hit the notification bell so you don't miss when I drop the next one. I talk all about real estate, investing, and entrepreneurship. And as always, don't forget to follow me on Instagram and TikTok. I give more advice on those channels as well. Until the next video, guys, stay safe and stay blessed.